Welcome to the deep dive. So many of you constantly weigh exchange-traded funds versus mutual funds, and you're often wondering, is there a clear winner? Or maybe we're asking the wrong question. Today, we're not just comparing two things. We're really trying to unlock a strategic framework, how these tools can work for your specific financial goals.
Exactly. And this deep dive, it's specifically for you. You might be an NRI, a non-resident Indian, or maybe an H&I, high net worth individual, or perhaps part of a family really focused on, building that generational wealth. Our mission, it's to uncover the insights that matter most, the ones that directly impact your financial strategy.
Okay, let's unpack this then. Fundamentally, what's the core difference in, how these two actually trade, and what does that difference mean strategically?
It's really about access and timing. Think of a mutual fund, maybe like a school bus. You buy or sell units just once a day. At the closing net asset value, the NAV, it's a single price for the whole day, usually done directly with the asset management company, the AMC. And strategically, well, for many, this sort of built-in delay, this inertia, it can actually protect you from making impulsive emotional decisions.
Right. So it's more hands-off, a bit like set it and forget it, which, yeah, that could be a strength for long-term planning. But what if you want to be more nimble? What if you need to react to market shifts during the actual trading day?
Well, that's where the ETF comes in, the exchange traded fund. It's more like a local train, maybe. ETFs, they're listed. They trade on a stock exchange, just like a regular stock.
Yeah.
Which means you can buy or sell them anytime during market hours at real-time market prices. So you get immediate liquidity. Now, this offers huge flexibility, definitely. But there's also the temptation to perhaps trade too much.
That real-time flexibility, yeah, that sounds like a game changer for control, for responsiveness. Okay, let's dive into the practical pros and cons now, especially thinking about someone building wealth in India.
Sure. So for mutual funds, a really big plus is the professional management. With an actively managed fund, you've got a fund manager, a whole team doing the research, picking stocks. They're trying to beat the market. If you're a busy professional, this saves you a lot of time, right? Not having to pick individual stocks. And also SIPs, systematic investment plans. They allow those disciplined, regular investments. That's a real game changer for family wealth creation over the long term. It averages out the bumps.
That discipline is invaluable, absolutely. But that active management, it usually means a higher expense ratio, doesn't it? That annual fee. Is that higher cost always worth it?
Not always, no. And that brings us to ETFs, their biggest draw, incredibly low costs. Most Indian ETFs, they're passively managed. They just track an index, like the Nifty 50. Since there's no active stock picking, the expense ratios are often tiny, sometimes less than, say, 0.20%. For an H&I, a high net worth individual, these savings can really add up over time, significantly. But here's the interesting insight. ETFs have low expense ratios, yes. But that very real-time liquidity, it can ironically eat into savings. How? Through frequent transaction costs, brokerage fees, and maybe behavioral biases if you're not careful, if it's not managed strategically.
And thinking about our NRI listeners, the non-resident Indians, that real-time ETF trading seems like a unique advantage, reacting instantly to global news, even from different time zones. But there's a flip side, right? Some niche ETFs in India, maybe newer ones, they can have low liquidity, which means higher bid-ask spreads that gap between buying and selling prices. Effectively, it costs you more to trade. So yeah, the flexibility is great, but it can be a double-edged sword if you're not watching those details. Precisely. And, navigating this whole landscape, the costs, liquidity, your own investment behavior, that's where things get tricky. It really raises a key question. How does a wealth manager, or say a certified financial planner, a CFP, how do they really add value beyond just picking funds?
That is the crux of it, isn't it? Given all these nuances, these pros and cons, where does that advisor truly make a difference for you? Well, they become your financial co-pilot. They help create a holistic plan, looking at the whole picture. For NRIs, this is absolutely crucial. They help navigate complexities like repatriation, getting money back home, different tax laws, specific regulations like FEMA, the Foreign Exchange Management Act. It's complex stuff. For an H&I, it's often about strategic wealth preservation, diversification, maybe using a core portfolio of low-cost index ETFs for broad market exposure, and then complementing that with some actively managed mutual funds for specific sectors or maybe themes they believe in. But perhaps most importantly, they provide discipline, helping you make rational, goal-based decisions, preventing those impulsive moves driven by market noise, making sure your portfolio stays aligned with your life goals. Honestly, for complex wealth-building journeys, that partnership is pretty much non-negotiable.
That really highlights it. It's not just ETF or mutual fund, it's about how you strategically combine them, often with expert guidance tailored to your unique situation.
Absolutely. Maybe a final thought for you to consider. As you navigate the dynamic world of Indian finance, what's just one area of your current financial plan where taking a fresh look, a strategic review of both ETFs and mutual funds, perhaps some expert guidance, where could that unlock an untapped opportunity, an opportunity for real, lasting generational wealth, something to think about?